Okay, good afternoon, everyone, and welcome to our webinar today. I am Peggy West, your organizer, and today's webinar is the board member certification with some financial tips. I'll start by introducing our guest speakers today. They're icons in the industry. I'm going to start with Scott Lee, Esquire. Scott has been practicing law for almost 30 years, since 1995. He is one of the few attorneys who are both a Florida Bar Board certified condominium and plan development law attorney, as well as a Florida Bar Board certified real estate law attorney. Scott routinely presents homeowners associations, condominium associations, and co-ops in all areas of the community's operations, including amending, preserving, and revitalizing government documents, covenant enforcements and procedures, aggressive collections and delinquent assessments, and reviews vendor contracts and mortgage foreclosure and tax deed surplus matters. Scott also is involved in the termination of condominiums, material alterations, and special assessments in matters that regularly draft special meeting notices, limited policies, and oversees election procedures. He serves as the Palm Beach County Bar Association Community Association Continuing Legal Education Chairperson for 2022 and 2023, and provides lectures to other attorneys on community association legal issues. Scott also was nominated for the 2020 Justice Olmstead Award for Florida Bar Board Certified Attorney of the Year. I also want to take a minute and introduce Nicole Johnson Pendergrass of Hafer CPA firm. She has received her Bachelor of Science in Accounting from Cabrini University in Pennsylvania. She started with Hafer and Company in 2005 as a staff accountant, was quickly promoted to the Director of Operations, and is now a partner with the firm. She teaches various organizations of financial statements and accounting. Her extensive knowledge in all areas of accounting makes her an asset to every organization. She is also a member of the Common Interest Realty Association and also the Florida Institute of Certified Public Accountants. She's involved in various nonprofits and enjoys giving back. And her motto is always strive to be the best to your clients, and they are what matters in success. So with that, I'm going to turn it over to Scott.
Thank you so much, Peggy, and thanks everyone for joining us today. Thank you very much to all of our sponsors who make today's presentation possible. Thanks, of course, to my partner in crime, Nicole. We've done many of these lectures over the years to board members as part of the certification process. We hope that this is real informative. It's going to be 2 hours of action-packed information. There's an overwhelming amount of information that you as a board member need to have a general idea of and learn about. It's impossible to cover every topic and every nuance and every issue and every rule or every law, but we're here to try and give you food for thought and ideas going forward as a member of a board of directors, which we commend you for joining a board of directors. It's, from what I understand, the compensation to be a board member is not very lofty. So you're all volunteers. And I work with boards, of course, with all the community associations that I represent, which are approximately 150 or so in Palm Beach County and Broward, Miami-Dade, and some in Martin County. And it's my pleasure to present today's course and some quick, real brief housekeeping. And then we're going to go into let the sponsors introduce themselves, of course, after Nicole does. At the conclusion of the course, you all will get a certificate emailed to you that you participated, which you should keep. That's part of the official records, and it satisfies your obligation if you're a new board member. If you're not a new board member, hopefully this is just informative and helpful in the scope of your duties as a board member. It will take a few days to get that certificate emailed to you, so just bear with us because thankfully we have a terrific group of participants, a great number of you. But probably within the week, you'll have an email from my office with that certificate. Post course today, feel free to reach out to me if you have additional questions. I believe you might have my information for that purpose, but just in case, my phone number is 561-340-4555, and my email is Scott, SCOTT, at S as in Sam, J as in Jack, W as in William, lawgroup.com. And I look forward to hearing from you folks after the course. Nicole?
Thanks, Scott. And I agree, partner in a crime. I'm excited, everybody. I see all the lists that we have on the panel today. It's a great class. Scott really presents and really helps you understand. And as board members or property managers, there's so much going on, and you are volunteer boards. And the fact that you're taking the time to attend these classes to make sure that you're making the right decisions. I can't emphasize that enough to my board members, that you need to make sure, even though you are a volunteer, that you're staying on top of running this like a business and abiding by the statutes. So there's a lot of information today. Take some notes, reach out to Scott, myself, if you have any questions after the seminar. We're always more than happy to respond. Scott responds so quickly. I said, does he ever sleep at night? So you will get a response back. And I appreciate you being here today. And I hope you get a lot out of this seminar. Thanks again.
Okay, with that, I'm going to start introductions of the sponsors. And I just want to say that these webinars would not exist without my sponsors, moderators, and IT support. I am Peggy West again. I am a new consultant with Beach and Patio Outdoor Living, as well as my organization of the Smart Cam webinars. A little bit about Beach and Patio. We've been in business for 50 years, and we do provide new furniture as well as repairs. Repairs are primarily in the South Florida market. And right now we have a special running on reslinging your pool deck furniture for your chases and your chairs at a really nice, affordable price. So let me know if you need anything like that. And I will be sending out a sponsor sheet with everyone's contact information, phone number, and email. And just let me know if I can help you in any way. I also want to go on and introduce the IT support Vinteum software. We have Layla Scola on today. She's head of customer success and marketing and the IT support. Layla, tell us about yourself and the company.
Thank you, Peggy. My name's Layla. As Peggy said, I'm the head of customer success and marketing here at Vinteum. I've been working with the company for 5 years now. And Vinteum is a software company. We provide websites and secure password protected portals for your HOA or condo to improve communication management. It is really great to have a website. So if you're interested, please do get in touch.
Great, thank you. And I also want to say honorable mention to Yasmin Johannes, if you'll tell her. She is the marketing manager and another part of the IT support for Vinteum. Again, we couldn't do these things without you ladies. Thank you. Next, I want to introduce Rudy Martin. He's the Director of Strategic Business Development for M2E Engineering. Rudy, thank you again, and tell us about yourself and the company.
Thank you, Peggy. My name is Rudy Martin. I'm the Director of Strategic Business Development. M2E is a full consulting engineering firm, from the building's conception during turnover, from handling the building after it's we find minor defects. Of course, we're doing the milestones and the SIRS, but we do so much more than that. If you have any questions, you will receive an email from Peggy after this is complete with everybody's contact information. We are recording this, so it will be on Vinteum's website. We'll share that link. Also, the Q&A button on the bottom of your screen. If you have a question, please click there, ask the question. We'll get to as many questions as we possibly can. We're going to save most of the questions probably to the end because all of your questions will probably be answered by the end of this seminar. So use the chat box for any positive feedback, and I'll be moderating this webinar as we go. Thank you, everybody, for joining.
Okay, Rudy, thank you so much. Okay, next I want to introduce Lilia Ziano. She's the Vice President of Customer Relationships at Metropolitan Bank. Lilia, can you introduce yourself and what do you do and what is Metropolitan doing for the associations?
I don't think she could join today, Peggy.
I see her on.
No, it's Sophia.
Oh, I'm sorry. Okay, let's move into Sophia then. Sophia Diaz, she's the manager at Plenty Office Services. This is her first time sponsoring. Sophia, tell us about yourself and the company.
Good afternoon, everybody. Thank you for having me, Peggy. My name is Sophia Diaz. I am the manager for Plenty Office Services. We are proud to be a family-owned business, licensed and insured in the state of Florida. Plenty Office Services was actually established in 2015 with the purpose of developing a trustworthy, professional, and committed commercial cleaning and maintenance company. We take very great pride in maintaining long-lasting relationships with all of our clients, and we try the best to provide the best service possible. Some of the services we provide are general office cleaning, construction cleaning, and condo maintenance. Some of the tasks in that include service, trash removal. We do maintain the pool and bathroom area of any condo and neighborhood, and we do refill and maintain the doggy bag stations. We do work very, very closely with property managers and HOAs to maintain the cleanliness of those properties. So we are always very interested in nurturing those connections. And although our focus is the cleanliness, we can and will accommodate to whatever is necessary for any account. Thank you again. My name is Sophia Diaz.
Thank you, Sophia. You look so much like Lily. I didn't even look at the name on the screen. Okay, so
Have that
let's move-
face.
There you go. So with that, I want to say congratulations to the new board members on today. Like Scott said, you are running a multi-million-dollar business here. So let's hear what Scott and Nicole have to say.
Thanks, Peggy.
Mhm.
So I like to start with kind of the 10,000-foot view of community associations. The first question that comes up quite a bit, from board members when they're asking me, a particular legal issue is, what do we do? How do we figure out the answer to these questions? What is the governing authority to determine the answer to a question? The governing authority to dictate how you as a board member proceed and how the association functions. And there are a whole slew of things that guide us, community association practitioners, attorneys, accountants, board members, property managers, in terms of how an association functions and what they can do and what they can't do, and how members interact with the association, with board members, etc. So the scope of authority is multifold. We have 3 sets of statutes, depending upon what type of community association you're in. For a homeowners association, single family homes, it's Chapter 720, Florida's Homeowners Association Act. It's a body of law. It lays out a whole series of statutory provisions that cover a variety of aspects of Florida Homeowners Association governance, practice, and procedure. Doesn't cover everything now. Chapter 718 governs condominium associations, so euphemistically known as Florida's Condominium Act. And then we have the rare breed in Florida of co-ops. Not too many down here in Florida, although I do represent a few. Co-ops are more of a animal that we see in New York and other states, but we do have a few co-ops, and that's governed by Florida's Cooperative Act, which is Chapter 719. So we have statutes that really are the overriding set of authority that we as community association practitioners have to know chapter and verse in and out, and compare and contrast how those statutes read in relation to the next set of authority, I'll call it, which are called your governing documents. Now, I oftentimes hear from my board member friends that they just reference the governing documents simply as the bylaws. I'm going to correct something right out of the gate. Bylaws are one aspect of your governing documents, but it's actually not nearly as important as something called your declaration. And virtually every homeowner association, as well as a condominium association, has a declaration. For HOAs, it might read something like declarations, covenants, and restrictions, and easements. some interchange of those words that make up your declaration, and that's for lack of a better word, the thicker set of documents, voluminous, pretty substantive, and it covers, a great deal of the rights and obligations of the association and the unit owners and the members. Then we do have bylaws. Bylaws do exist, and bylaws are typically an exhibit to your declaration, but bylaws are almost exclusively focused on procedures in terms of meetings, noticing board of directors meetings, and other miscellaneous procedural issues, say involving parliamentary procedures in terms of how a meeting is to occur. Sometimes it identifies the number of members on the board of directors and their terms. Those types of procedural aspects, more focused on two things again: the configuration and operation of the board of directors, and the noticing of board of directors meetings and special meetings and annual meetings. Important, but not nearly as important as the declaration. Thirdly, we have articles of incorporation. Articles of incorporation, again, typically an exhibit attached to your declaration, are essentially the birth certificate of the corporate entity, because your community association is a corporate entity filed with the Division of Corporations of the state of Florida as a not-for-profit corporation. In order to create that entity, there needs to be articles of incorporation. And that's true for just a traditional business entity, aside from your community association. Articles of incorporation oftentimes are just the document crafted by the developer of the community, referencing the initial set of directors, which are typically made up of developer-controlled individuals. Rarely will you see something that is important in the Articles of Incorporation in terms of the governance of the association. Once in a while, there is something that comes up that isn't otherwise referenced in the bylaws or your declaration, and if something is found in the Articles of Incorporation, it could be binding on one aspect of the governance of your community, but that is a rare event. And there's a hierarchy of, in terms of which of these three documents, your declaration, bylaws, and Articles of Incorporation, control. It starts with your declaration. This is by statute. Florida's Homeowners Association Act, as well as Florida's Condominium Act, says something that is found in the declaration that is inconsistent with something, say, in your bylaws, your Articles of Incorporation, control and take priority. So your declaration is, we'll call it the highest and best. Second place are your bylaws, and third being your Articles of Incorporation. But in order to understand the breadth of all the pertinent language that may apply to a particular legal issue, it's necessary to review each one of these documents. But if it's covered by the declaration, and the declaration is going to be your guiding authority. Subject to what I said before, are statutory schemes. Again, whether it's Florida's Homeowners Association Act, Florida's Condominium Act, or in the rare case for cooperatives, Florida's Cooperative Act. If we have something in your declaration that reads one way, that is inconsistent with how the statute reads and mandates, then the statute is going to control. Even if your language in your declaration or your bylaws is crystal clear, and it's been that way for 30 plus years or so, the statute is going to be number one in the chain of enforcement. So we have your statutes, we have your governing documents, which are made up of the subset of your declaration, your bylaws, and your articles. Then number three are rules and regulations. Rules and regulations are important, but rules and regulations fall after statutes, governing documents, including the declaration, bylaws, and articles. And rules and regulations are promulgated just by the board of directors. And they typically are there to kind of fill in the gaps. Something that's not otherwise covered in your declaration or your bylaws, the board is authorized, to come up with rules and regulations that could very well be enforceable as long as it's reasonable in nature. And we'll talk about that later on. Now, let me throw a whole monkey wrench into everything that I just said. Let's say there's something in the statute that reads pretty clearly, or something in your declaration also that reads pretty clearly. but there's a challenge as to the validity or the enforceability or the appropriateness or the constitutionality of something that is contained within one of these bodies of authority or these documents. Well, case law has developed over time. There's an extensive body of case law dealing with community associations where from time to time, you'll have a statutory provision that is deemed unconstitutional, or you'll have a provision in a declaration that a court of law, typically done by a district court of appeals panel, will read that particular provision in a certain way and require that it be enforced in a certain way. So the caveat to everything I just said is that if there's existing case law in the state of Florida, written opinions that us attorneys have access to, and you folks may have access to as well through LexisNexis or some other research service, that case law also has to be understood in relation to the particular issue at hand when seeking to enforce something and based upon the statutory provision or a section of your governing documents. As far as the division of condominium, there's not case law per se, but there are arbitration decisions that deal with condominium related issues that have binding value, just like a case that's decided, say, by the 4th District Court of Appeal. So arbitration decisions are also an important way of understanding whether a particular aspect of association governance can be done this way or that way. And arbitration decisions oftentimes come up in the context of elections. There's a whole slew of division of condominium arbitration decisions pertaining to the way in which elections are conducted. When there's, say, some vagaries in your bylaws or in your declaration, or the statute might not even cover it, there's a gap as far as the existing authority to look at. And that's where us lawyers end up asking for judicial intervention with the court system, or if it's a condominium matter, or if it's an HOA election matter, because HOAs are, believe it or not, HOA election disputes are governed by the division of condominium as well. We'll get guidance from arbitrators as it relates to those issues. So that's the world of governing documents, authority, statutory authority, case law that make up when Scott sits down and types an email to my clientele, to the board members, asking me a legal question. It's not just Scott's idea of what's right or wrong. It's based upon how our documents read in relation to how the statutes read in relation to existing case law on the subject, to hopefully come up with the right answer in order to guide you guys as board members, board director members, and to go forward knowing full well that you're within your authority to go this way or that way as to a legal issue. And in addition, sometimes there's grayness. Not every single issue, and it's kind of infinite in terms of the issues that come up with community associations, has an exact answer. Sometimes there are best guesses. Sometimes the issue can be resolved this way or that way because the cases or the statute or your governing documents aren't clear cut. So we apply equitable principles to a situation at hand to, the best guide you folks to make the best decision for the association in order to avoid liability and to do what's right for the association and to, for lack of a better word, stay out of trouble. So that's my 10,000 foot view explanation. Now we're going to kind of dive into some more specific details of association governance, topic by topic. And the first topic, I'm going to turn over to my friend Nicole about the preparation of budgets.
Thank you. One thing I can't emphasize enough that Scott was just talking about is, as a board member, before you enforce or you have any concerns, always reach out to your attorneys. I don't know how many meetings I go to and talk to my board members that, the most important thing you can do is rely on your professionals. So if you have a concern about your documents or declarations or bylaws, the most important thing is reaching out to your attorney, asking them first before you do anything, because you don't want to put yourself into a bad situation as a board member. So preparation of budgets. It's been quite an interesting 3 years since the pandemic, through everything that's been going on with the pass of the new law last year and everything with associations. And I always tell my boards, the most important thing is always look at a budget as an estimate, but make sure it's an accurate estimate. And what's happened in the last couple of years with many of associations is they're always trying to meet a certain number and saying, this is the number we feel our associations and our unit owners can afford to live there. What you need to look at as a board member is, what do we need to assess and do the maintenance fees to make sure this association is financially solvent? You need to look at it as a true business. I'll hear too many times when I'm out there helping with budgets or doing the year-end financials, and it always comes up, well, we're really a nonprofit. You're not a nonprofit. You're a profit organization with the IRS, and you are truly a business. You're running millions of dollars through an association, and you're controlling those funds. So you need to really look at that budget planning and saying, what do we need to do to make sure that we are staying financially solvent, especially with the situation of Florida being such a hot market. Everybody, the influx of people down here, they're really looking at your budgets. They're looking at your financial statements and saying, are you the community we want to buy into? Because of the tragic event that happened in Surfside, people are really now starting to say, I need to look at those audits. I need to look at those budgets and make sure, is the board doing their fiduciary responsibility before I buy in there? So regarding the preparation of budgets, there are some stipulations with 718, 719, 720. So for 718, if you are a condominium association or a cooperative under 719, there are specific rules in the statutes that you have to follow regarding those budgets. And you want to make sure that you have your licensed CAM and your attorneys involved when you're doing this, making sure that you're putting out the 14-day notice, making sure you're having the budget meeting. Also, preparation before that. Make sure that you're meeting with the boards and sitting down in preparation of that. I would say, July. A lot of times my boards with December year ends are sitting down in July and August and working on those budgets. They're getting a 6-month actual, and then they're taking it out through the end of the year and seeing where they are financially. Did we budget enough in the prior year? Where do we need to be in the next year? And then also on the condominium side, and I'm going to specifically talk about condo and co-ops, is the preparation of the reserve. The most important thing in the budget preparation for 718 and 719 is having those reserve calculations done correctly. Too many times we come in at year end and we'll see a condominium association that issued a budget out and they gave the option to the owners to waive or partially fund those reserves, but there's no schedule. It is required under 718 and 719 to have a reserve schedule. If you're in the component method or the pooling method, you're still required to have the schedule. And what the schedule shows is how the calculation came up with fully funding those reserves. It's based on all the line items in reserves, painting, paving, roofing, anything over 10,000. The pooling method is a different way of calculating the reserves, but it's still required to show the schedule how you're funding those reserves and where that funding comes from. So preparing those budgets is very crucial to the community and also to be in compliance with statute. Now, 720 Homeowners Association is a little different in the sense. I always call it the Wild Wild West because there's not really a restriction on how the budgeting process takes place unless your documents are specific. And if your documents have something in there, you'd have to talk to your attorney. It might be specific for your association. But under 720, you're putting a budget together. If you're non-statutory reserves, which means that the developer never established the reserves or the community never voted to have them, you have something called a voluntary board reserve. And there's no requirement of the membership has to vote to partially fund those or fully fund them. Some communities don't even have a reserve schedule. It's not required. I would recommend it, especially if you have a lot of components of reserves in an HOA, but it's not required as a part of the budgeting process. So there's no membership vote. In condo world, condo and cooperative, if you decide that the board says, we really don't believe that fully funding the unit owners can afford that, you can go to the membership and get a vote of the membership to partially fund those reserves or waive those reserves. But it does require a membership vote under 718 and 719. So it is something that we'll see a lot of deficiencies and sometimes year end because they don't go out and get the membership vote. The board's responsibility is to put a budget together with fully funding reserves. And then if they choose to allow the membership to partially fund or waive them, they can do that. But the budget process is required to show fully funding reserves. And the point of the schedule to put that in as a part of the budget is because the owners need to know what they're waiving. If there's no schedule and you put out a budget saying fully funding is 150,000, this is what your maintenance fees will be. And then you say, if we waive the reserves, this is our amount. People are going to look at the amounts and say, okay, I'll waive the reserves if there's no schedule. If they have a schedule, which is required, they're going to educate themselves and say, well, if I waive this, this is what I'm going to have to pay eventually, because that money is going to be paid either through a special assessment or through the budget. So it is crucial to put those out there, and it is required by statute. Also, what I'm seeing in a lot of budgets right now is board members are being hit with these large insurance increases, and it is across the board. So if you're in an association, everybody's being hit with these large increases in insurance. What you're seeing right now is some associations, because they are doing their budgets in July and August, and their renewals aren't until March or April, they're getting hit with these increases, and they're either having to come back and amend the budget, or they're having to pass a special assessment to pay those insurance premiums. So you should be really sitting down. What I recommend is when you do the budget, any contracts that you have, send out to your vendors and say, do you have any increases you anticipate next year? Now you can make that pretty close to the estimate. Then sit down with your insurance agent and say, where do we think we're going to be next year? They're going to be able to give you an estimate. They don't know accurate, because we didn't know these increases last year. I had some associations that went up 100% in the insurance arena, in the condo world. They didn't anticipate that. Their agent didn't anticipate that. So they had to look at that and say, what do we need to do? But a budget is just an estimate. And you really should be sitting down and going line by line and saying, where can we cut costs, or where do we have to increase? And you never start with your income. You always start with the expenses. I have too many boards that'll say, we want to be $250 a month, and then they work back into expenses. That's not a good way to do a budget. Always start with your expenses. And then if there's things that don't have to be done, they're more cosmetic, you could say, maybe we'll wait a year to do that. But you really have to start with those expenses and make sure you're abiding by statutes when you're putting those budgets together.
Nicole, on that statute, does statute 720 mandate that reserves are specifically designated by category, roof, clubhouse, gates, etc.?
So under 720, if you are non-statutory reserves, you can have something called a deferred maintenance, or you could have just a general reserve, because they're not statutory. If they're statutory reserves, which the developer established or the membership voted, now you're following condo law because they're statutory, and you're required to have them listed out. You can do the pooling method or component, but yes, you would have specific categories that are listed, probably based on a reserve study, and they have to be specific what you're funding for.
Now, a two-story building, do they have to fully fund their reserves?
So I think we're going to talk about, that's a great question later in the presentation when Scott gets through. It's a great question, but I think Scott will cover that through the passing of that last law.
Perfect. We have a few more that have to do with voting. We have a few more that have to do with, signed envelopes, access to documents. And I think Scott's going to cover those. So hopefully he'll answer those and we can clear them out. Thanks.
He will.
And Rudy, the quick answer to your question, and that was an open question that many folks weren't quite sure the answer to. And the Division of Condominium came out with a declaratory statement as relates to two-story condos that they do need to fully fund. But that was a good question, and a lot of folks were quizzical as to whether or not the new statute SB4 in May 2022 called for that, and the Division of Condominium issued a clarification advisory opinion as it relates to that. So the answer is yes, as it relates to two stories. But we'll dive into the legislation from May 2022 and the niceties, the potential glitch bill, as we call it, the possible, let me emphasize possible, fixes to the SB4 May 22 legislation later on. But next, I'm going to go into some basics about how to run a board of directors meeting and certain aspects of board of directors meetings. This part you probably understand fairly well. What is the president's role? The president first does not have any superpowers. He doesn't have any more votes than any other member of the board of directors. He doesn't have the right to establish the agenda all by him or herself. He doesn't have the right, to kick people off the board of directors that he doesn't like or isn't nice to him or her. The president simply has one function. It's to run the board of directors meeting, to run it properly, to follow the agenda, to follow Robert's Rules of Order, a very important function. But sometimes we do see on our community associations a bit of a president perhaps overstepping in terms of their so-called ability to control things within an association, and they're just a board member. And as that president, they are an important, but they're a traffic cop as it relates to how that board director meeting is to flow. Vice president simply steps in if the president is absent or the president resigns. And we have the basic treasurer and secretary, and those roles are pretty self-explanatory. What makes a board of directors meeting? That's an important question. That fair amount of confusion out there. It's if there's a quorum of the board, so hypothetical, we have 5 board members. If you have 3 of the 5 getting together, whether it's at someone's house to drink coffee or to meet together at the diner or to hang out at the pool, where association business is being discussed in any form or fashion. So does this happen all the time where you have a quorum get together informally and have these types of discussions to go over something fairly quick that needs to be resolved? Sure. But here's where the technical and the practical diverge a little bit. And I always have to live in the world of the technical. And the technical answer is you have 3 of 5 board members getting together at any location to discuss any semblance of association business. That constitutes a board of directors meeting. What does that trigger? It triggers an obligation that the members know about that board of directors meeting. And how they know? Through a notice. And for homeowner associations and condominium associations and co-ops, those traditional regular board of directors meetings have to be noticed with a posting of that meeting in a conspicuous location. That's the wording out of the statute, typically at a clubhouse or a guardhouse or a bulletin board, at least 48 hours in advance of that meeting. So the point of this little hypothetical is to advise you folks as board members, whether new or you've been on the board for many years, to avoid having that 3 of 5 get together and secretly, for again, lack of a better word, get together to discuss association business. The reason behind all this is similar and akin to why our governmental agencies have to conduct business out in the open through the sunshine laws that you may be familiar with, meaning sunshine is supposed to come down on our agencies so the electorate, the citizenry, can see exactly how these agencies are making decisions, to have the benefit of their deliberative process. And the same is true with community associations. When you have 3 of 5 getting together to discuss an issue, important or semi-important, again, the membership is supposed to be able to witness that event. So bear that in mind when you're informally getting together with other board members, friends or not friends. Just try and avoid triggering that notice obligation by having 3 of the 5 of you get together. 2 of 5, no problem. You could sit together in someone's living room and chat all day about association business because you don't have a quorum, and thus you don't have a meeting, thus you don't have a notice obligation. Emails. It is in our electronic world, we all communicate by email, obviously, and the same is true for board members. However, when board members are shooting emails back and forth to each other, discussing an issue of association business, that's technically avoiding a board of directors meeting and keeping the membership from benefiting from witnessing the deliberative process again. So be real careful about the emails flying back and forth between board members, a quorum of the board, to discuss a substantive issue impacting the association. It technically needs to be done at a board of directors meeting. Now, there are a series of exceptions. I'll start with one of my favorite examples, and I call it the ministerial decision. What I mean by that is something kind of minor. And here, the example I use is your property manager sends out an email asking the board if it's okay if the pool maintenance person shows up on Tuesdays and Thursdays instead of Mondays and Wednesdays. Something like that, I don't see as being necessary to wait for a board of directors meeting. It's really, it's minor in nature and it's a scheduling issue at most. But if there's an email being circulated among a quorum of the board to decide to hire this contractor or this or that contractor to replace a roof and the pros and cons of the various contractors, that's a pretty big deal. That's a pretty big issue. That really should be discussed at a board of directors meeting. Another exception to the rule, if we have kind of an issue that can't wait for the next board of directors meeting, 3 weeks from now, we need to jump on something, including hiring a contractor involving an issue that needs to be handled immediately or something else that has some sense of urgency behind it, then I believe in that circumstance, emails will probably be acceptable. But, don't make it a routine habit to decide things via email and just rubber stamp them at a board of directors meeting. That could be deemed, and certainly, almost certainly will be deemed violative of the notice obligation of the association in terms of board of directors meetings. I've also heard terms out there called executive sessions or workshops. There's no such thing as a workshop. And a workshop can be done, but in the context of a board of directors meeting. I've had a few of my community association board member friends say, well, Scott, this is just going to be a workshop where the members are going to be invited, but we're not noticing this. It's not a formal board of directors meetings, but we want to just put out for discussion, for digestion, certain issues and certain things that we're thinking about as a board, and we want to get feedback. Well, if you have a quorum of the board, you have 3 of the 5 in my hypothetical, whatever issue you're being bantied about between the membership and the board, even if it seems informal in nature, that is a board of directors meeting. So it should be noticed as such. You could still have that discussion in a workshop fashion, but do it in the context of a board of directors meeting and properly notice it. And for condo associations, that has to be an agenda item. This is also and you'll hear this perhaps a few times when me and Nicole speak, and Nicole already hit on this as it relates to reserves. HOAs and condos diverge in a lot of places and many areas of the law. So what may be true for condominium associations might not be true for homeowner associations. And that's, to Nicole's point, that's very true for statutory reserves. That's also true involving the nuance of agendas. HOAs technically don't have to post agendas for their meetings. Some do, and I think it's a fine idea to let the membership know, what issues are to be discussed at the upcoming board of directors meetings. Condos have to post an agenda. So just be aware of that distinction. Executive sessions. I've heard, again, from my community association board member friends, Scott, the board, we have to get together and have to discuss this, but the members can't be present. It's just, it's going to go downhill quickly, and we got to get out of there in 45 minutes. Otherwise, it's going to be a 4.5-hour meeting. And while I fully sympathize, with that thought process, and I've been at those 4.5-hour meetings, that's not permissible. It's not permissible just to close the meeting to the membership. Again, with two exceptions. And us attorneys, we live in the world of exceptions and exceptions to the exceptions. And here are the 2 exceptions to not being permitted to just close a meeting and not invite the members. The first is when yours truly is present, your attorney, to discuss pending or threatened litigation. Litigation being a lawsuit. So if a member is threatening to sue the association over A, B, and C, and the board needs to strategize on what to do, or a lawsuit's actually been filed, whether it's by the association, against the association, and the attorney is needs to be invited and needs to be present at the meeting, either on the phone or by Zoom or in person, then that is a properly closed meeting. That's the exception to the rule where the meeting requires the members be invited. You still need to notice the meeting though. So don't think that you could just close the meeting and no one will know about it. You have to notice it as a closed meeting and indicate that the members are not invited to attend. The second exception to the rule is if the board is going to be discussing a sensitive personnel matter where, say, a property manager is going to be retained or possibly terminated, or the maintenance person is going to be replaced. In that setting, it is permissible for the board to label the meeting a closed meeting, notice it as such, and not have the members present. I oftentimes am asked whether or not a member can videotape or audio tape a meeting. Yeah, it's disconcerting, honestly, when a member comes in with their iPhone and they do this with, and shining it right at the board. That's not fun to have that put in your face. Here's the answer. A member has the right to audio tape or videotape the meeting, and we can't prevent them from doing so. We being the association, the board, the association's attorney. However, the statute provides that the board can promulgate reasonable rules and regulations as involving the videotaping or audio taping of that meeting. Here are the world of rules that you could possibly put into place. Require that member notify the association at least 24 hours in advance of their intention to audio tape or videotape. While we're not looking to be difficult with members, but it does create a hurdle for them, and a fair one in my opinion, to put the board on notice that they're about to be audio taped or videotaped in 24 hours at the next board meeting. And if a member doesn't do so, doesn't follow that rule, then you could properly tell that member that the audio taping or videotaping is impermissible. Also, that light shining exercise can be deemed improper and not allowed because it's distracting in nature. So any type of lights shining in your eyes as a board member, can be deemed not permissible, and that can be put to a stop. What about conduct at the meetings? Our favorite topic, and your favorite topic probably as board members. I'm sure if you've been on the board for any amount of time, you've dealt with a recalcitrant, ornery member who interrupts, is rude, says derogatory things. How do you deal with those situations? Well, you have the right as the board to shut that person down in terms of telling them that their time to speak is over. If they continue, and this is repetitive in nature, that could be the subject of a fine, because what they're doing is they're interfering with the governance of the association. Now, the whole fine procedure is its own category. You must have a fine committee set up, otherwise you can't fine at all. But assuming you do, if someone behaves in an unruly manner, that's a finable offense where they're acting in a nuisance, and virtually every set of governing documents has a nuisance provision. So fines can be imposed. You also could potentially have that person removed from the meeting. And if you know that this is about to happen or it's been going on, you may want to consider hiring a security guard, a police officer for that purpose, and have the individual removed from the meeting. And I've unfortunately seen that occur on a few occasions. Okay, I also highly advise that you let the members speak, but in a structured fashion. And technically, the members have the right to speak on each and every agenda item. I do see that many boards just let all the comments from membership occur at the very end of the meeting and kind of the open forum section. Well, I understand why. Again, the technical and the practical, are different in this respect, but the technical answer is each member, both for condos and HOAs, must allow each member to speak for a period of up to 3 minutes on a particular agenda item before a vote occurs. Because let's think about this. in terms of Robert's Rules of Order and the parliamentary procedure. When a motion is made by a board member and a second by another board member, then the board has the ability to deliberate as to that issue. And then what oftentimes happens, they jump into the voting as it relates to that issue. But before the voting occurs, what needs to happen is the members themselves, if any are present, should be given the opportunity to make their comments as it relates to that particular item. Because, think about it logically, the members are there to make that comment or speak for that definite time period in an effort to possibly convince the board members to vote a certain way. If they're going to make those comments after the vote has already occurred, it's kind of taking away from the membership the ability to participate in that aspect of the process and impact the decision-making of the board. So if we're going to follow things, the parliamentary rules of procedure the right way, if the motion is made, a second by another board member, the board deliberates as to the issue. Any comments from the membership up to 3 minutes apiece, and comments is important, then the vote. And when going back to the word comments, it is not a question and answer session. It is not an interrogation. It is not the member's right to sling arrows at you as a board, challenging you as to things. It's giving them the right to comment and just let them speak. And if need be, time them for that 3 minutes, give them a warning 30 seconds before, and then say, thank you very much, your time is up. And my time is up as it relates to this topic. So now I'll turn it over to Nicole involving annual audit obligations.
Great, thank you so much. My topics aren't as exciting because it's accounting, and we all know it's not great and exciting. But so the annual reporting at year end, it actually is in a good situation because 718, 719, and 720 all follow the same guidelines for year-end reporting. So I'm sure all of you are going through your year-end reporting right now. We're all in season and the deadlines are coming up. So according to Florida statutes for associations, it's all based on your income level, what you're required to do. And what I want to make sure I emphasize is it's all revenues. So if you pass a special assessment, if you have reserves, you have a capital fund, all of that is considered revenues. So it's all revenues that take into account. It's not just the maintenance fees that you're charging through the budget. It's all income. And I want to make sure I'm clear on that because a lot of associations, their budget might fall under a level, but then they have a special assessment. Let's say their maintenance fees are $450,000 on the budget, but they pass $1 million assessment. Your income would be 1.4 million. So you would be over the threshold on what you're required. So under Florida statutes, if your income level is under $150,000, you can do a report called a cash disbursements, cash receipts report. It's basically a cash report. You're stating what actually came in cash and what expenses were actually paid out. What you also have to have is you have to have the disclosures. You have to have a footnote disclosure regarding the reserves, and there are certain disclosures that have to be in this cash disbursements, cash receipts report. What I find interesting is that they put this into the statute because it's really not beneficial to anybody, these reports. If anybody has ever seen them, it's cash. So if you have a note payable, that's not recorded on the books. If you have receivables, that doesn't show on your books. It's strictly just cash in and cash out. So a lot of times if you have banks that you have notes with or loans, they won't accept that report because it's not really showing a true financial picture of the association. It's allowed by statute, but a lot of times it's not enough information for outside people that are buying into your community or your banks. They want something more detailed. Then the other report is if your income is $150,000 to $300,000, you're required to do a compiled financial statement. That means that basically it's your financial statements at year end and then all the footnote disclosures. It does not state in the statute that is required to be done by a CPA firm. So if you have management companies that can prepare or CPA firms that do bookkeeping that can prepare a full disclosure compiled financial statement, it is allowed. There is nowhere stating it has to be done by an outside company. Why most management companies and CPA firms that do the bookkeeping tell the boards to go to an outside company is because they don't have the full disclosure. You are required to have the footnotes as a part of that compiled financial statement. That includes the same footnote disclosures as an audit or review, all the reserve disclosures. So that is still required in the compiled financial report. Income from 300,000 to 500,000 is required to be a reviewed report. And it's basically analytical procedures. So that is required to be done by an outside CPA firm, just like the audit. They come in and they prepare your financial statements. They review them. So they're doing analytical procedures. They're doing review of your financial statements, and then they're putting a report together with the footnote disclosures. Then the last report is an audited financial statement. And that basically is them doing a test work. They're giving an opinion on your financial statements. They're evaluating your internal controls. They're giving a report after the audit is done. They're telling you if there's things you should improve on, and it isn't audited. So they're looking at invoices, contracts. It's a full disclosure audit, and they're giving you an opinion at the end. It is required if your income is over $500,000. Now, if the membership votes to decide not to have an audit if you're required and lowers the level of service, you can do that with a membership vote, but it requires a membership vote to lower the level of service, unless your documents state different. If your documents require an audit, I would reach out to your attorney and tell them, is that required based on your documents, even if your income doesn't fall into that statute's requirement? If you want to step up in service, say you're required to have a compilation and you want to do an audit, that is a board vote. A board can choose to go up in the report, but they can never go down without a membership vote. And that goes for all the statutes, 718, 719, and 720. It is required to be done and issued to the owners 120 days after year end. So in the statute, it says 90 days after year end, 120 days to the owners. So every CPA firm uses the 120 days because that's when it has to be issued to the owners and available. So you want to make sure you make it available to the owners. If your documents are specific, how you have to give that to them, you must abide by that. Talk to your attorneys, because if it's silent in there, you might be able to just give a postcard, make it available on your website. That would be something you would talk to your attorneys, how you can make that available, but it needs to be available by April 30th. And then your taxes are required to be filed by April 15th. You are allowed to have an extension with that until October 15th that you can get extended. There is no extension on the financial requirements under statute.
Great. Thanks, Nicole.
You're welcome.
So I'm going to kind of supplement the last category in terms of board meetings as relates to the notice issue. I had mentioned with board meetings, it's, you know, the traditional 48-hour notice for your regular board of directors meetings. What types of meetings require a different type of notice, an extended period? And here's just, you know, the list where you need to post or mail, where in most cases you need to mail a notice of the special meeting when it comes to adopting amendments to your governing documents. So the 14-day notice needs to be mailed out to the members with a copy of the proposed amendment to the declaration or bylaws at least 14 days in advance of that particular meeting. And that's really a members meeting because it's where the members are voting to adopt or not to adopt certain proposed amendments. Certain rules adopted by the board of directors also call for a special 14-day notice. Which types of rules? Rules affecting parcel usage. And this is parcel usage is the statutory term. And what's an example of parcel usage, a rule impacting parcel usage? Well, the adoption, say, of a color palette. What color can you paint your house? That affects parcel usage. Parking on your lot itself, or certain signage or flags that you can or cannot place on your particular lot. That impacts parcel usage. In a situation where a rule impacts parcel usage, a special 14-day notice needs to be sent out to the membership with a copy of the proposed rule indicating the board is considering the adoption of this rule. Also, I think Nicole had mentioned with budget meetings, a special notice needs to go out to the membership 14 days again in advance of that budget meeting with a copy of the budget or budgets if we're looking to waive reserves. So elections, of course, calls for a different set of notices, not 48 hours. And to following Nicole's theme, HOAs do have this wild, wild west type scheme in terms of there's no real set time period to send out these notices, although it's generally followed as 14 days in advance. However, most HOAs utilize and adopt the Condo Association notice provision, which is set by statute, which goes 60, 40, 35, 14. Let me define those. 60 is the first notice of the annual meeting. That goes out essentially soliciting folks to send in their notice of intent to be a candidate. Then 40 days before that annual meeting and election, the candidates themselves have to have submitted their notice of intent form if they choose to be a candidate. And 35 days before the annual meeting, if that candidate has a resume they would like to submit, that has to be turned into the association 35 days in advance of the annual meeting. Then the second and final notice goes out 14 days prior to the annual meeting, where the individual candidates are listed. And there's this double envelope system involving condominium associations that includes that 14-day notice. So keep those special notice requirements in mind involving these special types of meetings separate and apart from your traditional regular board of directors meetings. Fiduciary obligations at board, before I get there, let me say one thing about vacancies on a board. Time to time, your friends on the board may either move out of the community or decide they have had enough of this and they decide to no longer be a board member and a vacancy is created. I'm oftentimes asked, so what can we do as it relates to this vacancy? Do we have to fill that spot? Do we get to choose? Does that slot get open to a special election to the membership? The answer is, and us attorneys always rely on this language, it depends. It depends on how your governing documents read. Your governing documents will, and the bylaws in particular, will almost certainly have a provision dealing with vacancies on the board as a result of a resignation or otherwise. And these things and the procedure for filling that vacancy will turn on one word oftentimes, either the word may or the word shall. So if in those bylaws and the vacancies section of your bylaws, it says that the board of directors shall fill that vacancy, then the board must make a concerted effort to locate someone that's willing to volunteer to sit on the board of directors. That's because of that mandatory word shall. But if it says may, if the board may fill the vacancy leading up to the next election, then it's up to the current board to fill that slot or not fill that slot. They have no obligation to do so just due to the existence of that discretionary word may. Rarely, but sometimes you'll see a provision in your bylaws that calls for a special election in the event that there is a vacancy. So that's why the bylaws need to be reviewed to answer that question for you folks.
Scott, there's some questions about that. So it's their call if who they want to choose to fill that vacancy, or it depends on the documents, on the bylaws.
Correct. So say, we have the bylaws say shall or may, the board shall or may fill that slot. It's purely up to the board of directors who to choose. Now, you have to have a majority of the board agreeing, and the board need not solicit interested persons for that purpose. Would it be perhaps the nice thing to do? Okay, yes, arguably, but the board could just say, you know what, we know this person has been active in the community. We know they're level-headed, that we know that they'll work well with us. They could just select that person. If a majority of the board decides that this is the right guy or girl to fill the spot, then that person can get appointed without having to go around the community and send out any type of special notice, seeing if there are any other interested persons.
Have you ever heard of a CAM making a motion from the floor to amend reterm limits for boards? Their docs clearly state that it has to be in writing, but I guess there's a CAM that kind of makes a motion to reterm and extend limits for board members. Have you seen that happen before?
I love my property manager friends, but no property manager should ever be making a motion at a board of directors meeting. Each and every motion should be made by a board member. And as far as modifying terms, if the bylaws have specific language, calling for a specific term, That cannot be altered by way of a board motion. That's going to require an amendment adopted by the membership.
Is there a required number of members based on condo units? If it's a 700 unit property, is it okay to have 3 board members manage that many units?
Yeah, I mean, the bylaws sometimes will say, even for a large community such as that, if the bylaws say the board shall be made up of 3 to 5 members, and there are simply 3, then they're allowed to continue business operating with just 3 members. And with such a large community like that, I would recommend probably expanding the board to 5. And if there's that discretionary language to expand the board to 5, going from 3 to 5, the board alone can make that motion to expand the number of persons sitting on the board from 3 to 5. However, you don't do it mid-year. Mid-year, you don't just say, oh, we decided to make ourselves a 5-member board and we added these 2 folks to our board. The time to do that is at the next election. That's the proper time. But prior to that election, there should be a board motion taking that action, extending the board formally to 5 for the purposes of the next election.
Thank you.
Yep. Fiduciary obligations. So you folks are rightly concerned about whether or not you could be sued personally for your actions as a board member. Again, you're volunteers, not getting paid a heck of a lot of money. Pretty sure most of you get paid 0. And so you rightly should understand exposure, if any, as it relates to your activities on the board. The good news is your exposure is extremely limited due to a concept in the state of Florida that's been well established by case law called the business judgment rule. Case law throughout the state has established that board members are free to make decisions without risk of being called liable or negligent, even if that decision is a poor one, even if it's turns out to cost the association money. If it's a business judgment exercised in good faith, then there'll be no liability flowing to you as a board member based upon this business judgment rule. Having said that, that doesn't mean you may not get sued. Board members get sued all the time. So what do we have to make sure we have in place in that event? D&O, Directors and Officers Liability Insurance Policy. So the insurance carrier for the association steps in and defends you in that lawsuit. And almost always you're removed from that lawsuit eventually, but you still have to have an attorney make your case for you that you didn't breach your fiduciary obligation and no liability should flow in your direction. And you want the cost and expense of that attorney to be put on the insurance carrier through the D&O liability policy. So the first thing you should always ask when you become a board member is to make sure that there are directors and officers liability insurance to insure you as a board member. Of course, there are a few exceptions to this business judgment rule. If you as a board member, I'm sure none of you folks out there would ever do something like this, embezzle money from the association or engage in conduct which results in some type of physical injury to someone, like getting in a fist fight at a board meeting, that type of thing is not going to be covered by your D&O policy. Those intentional torts, it's called, or misappropriation of funds / embezzlement, those types of crimes, again, you won't have insurance coverage for that. So don't go down that road. Interestingly, as it relates to our bill from May of 22 involving the changing of the guard, the sea change with reserves and structural integrity reserve studies and milestone inspection reports involving condominium associations, our esteemed legislature snuck in to that legislation in May 2022 that if you as a board member at a condominium association do not obtain these required structural integrity reserve studies by December 31, 2024, not too far away, that constitutes an automatic breach of your fiduciary duty. So that's a serious thing. And that underscores kind of the importance of making sure we follow this new legislation, although it's in the midst of possibly being modified through what we're calling the glitch bills that are circulating back and forth between the House and the Senate, whether or not the breach of fiduciary duty part to the SB4 bill from May 2022 is going to be removed. I doubt it, and I don't think so. There's no suggestion that it will be. So there is a potential for being sued under a breach of fiduciary duty claim if you don't follow that new statutory scheme, which is a tough one. So my condo association board of director member friends, be on alert for that, and make sure that your property manager is following through, and you as a board are following through with your obligations involving that law, even if it's modified. The modifications do not appear to remove that prospective liability from you of a board member if there's a violation or failure to follow through with your obligations. Okay, I'm going to turn it back over to Nicole for some further discussion about reserves and
Sure.
the determination of amounts.
Okay, so I talked earlier about, the statutory, non-statutory 720, 718. So let's talk about the accounting methods of reserves. So the methods, how they're being done is the same for 718, 719, and 720. So there's two ways that you can actually fund the reserves. The first one we'll talk about is the component method, the straight line method. So after you have your reserve study done, they're going to give you a list of reserve line items: painting, paving, roofing, anything over $10,000. I do always recommend to have those studies done every 3 to 5 years. They're very crucial to the estimated replacement cost because that has a factor in how you calculate the fully funding. So once you have these studies done, they're going to list out all your components. And in the straight line or the component method, they're going to show on each line item an estimated cost. So they're going to say your roof, and they're going to list it, let's say, at $1 million. It's an estimate at that point in time, which they believe that's what the cost of your roof would be at that time they give you the reserve study. Then they're going to give you how many years are remaining on that roof. So let's say they came out and they evaluated your roof and they believe that you have 5 years left. 20 years is usually the life of the roof, but there's only 5 years remaining. In order to come up with calculating fully funding, you're going to take the estimated cost of that component less the amount that's in there. So let's say it's $1 million that they say it's going to cost you to do the roof, and you have 900,000 already in there. You have 100,000 remaining that you have to fund over the next 5 years. For each line item, that's how the calculation is done. You would take the funding you already have, less the estimated cost, divided by the number of years remaining, and that gives you the fully funding amount for that year. Then you would do that calculation for every line item in reserves, and that gives you the total of what your fully funding is for the next year in the budget. And it totals up all of the components, and that is fully funding. So a lot of people have the misperception between fully funded and fully funding. Fully funding is your funding every year for each component, that when that component comes due, you have the money to replace that and do the work on that. Fully funded would mean that you have all of the cash for all the components for all the estimated replacement costs. I never see any association fully funded, because that means usually they're not doing the work. They have the cash in there, but they're not actually doing the work, because funding should fluctuate. As you do work, that funding comes down. When you replace that roof, now you have another 20 years to build that back up to that $1 million. So when you do a new roof, your funding actually in roof should be zero, because the roof is brand new. And then now you fund it over the next 20 years. The other method of funding is called the pooling method, cash flow method. It does give you a little savings in the actual fully funding, but it's actually a cash flow method. And what happens in the pooling method is you're going to take your longest life of an asset in your reserve study. So let's say it's concrete restoration. Many associations never put concrete restoration in the reserve because it's the most costly, but it is the most expensive reserve that should be in there. But let's say it goes 30 years that you have to do concrete restoration. You're going to take your schedule now out over 30 years. and you're going to use a method, and you're going to go in and you're going to add in every time you need to do that component. So let's use painting. Let's say painting is every 7 years. You're going to put into your pulling schedule every 7 years, painting has to be done. So year 7, year 14, year 21, all that is going to be added in as your cost for year 7, year 14. Where a lot of people have deficiencies in the pulling schedule, they don't always, they'll put in painting in year 7, and then they'll never put it again in the schedule. Well, if you go out 30 years, painting isn't only going to be done once. So it has to be included in every 7 years as your calculation. Also, it has to have complete funding over the 30 years has to be the same. You'll see some people where they're putting the schedule together and they're increasing every year the funding. It's not allowed. It is not allowed to have a balloon payment. It has to be consistent with the funding. And people will say, well, how do we do that? Because then the next year, we know that costs are going to, the pulling schedule must be redone every year. So when you come in to do the pulling schedule next year, you're going to look at those estimated replacement costs. We know they've changed. And that is how your increase in funding will go, because then the next year when you redo the schedule, your funding can go up because you're redoing the schedule. It must be done on a yearly basis when you're doing your actual budget. And I find that's a big deficiency when we do year end, that boards are just continuing to use the same pulling schedule. It must be redone on an annual basis. If you're in the component method right now, and you want to move to the pulling method, which many associations have done that, it does require a one-time membership vote to move to the pulling method, to move all the old components into the pulling method. If you want to keep two separate schedules, because you can't get the membership vote, you can have the component method. All new reserves will be in the pulling method. And then as you spend down reserves, you would spend the component first, bring that down to a 0, and then everything would be in the pulling method. My recommendation is to try to get the membership vote, because 2 schedules of reserves becomes an accounting nightmare, and then you don't know which pot you're taking it out of. But most associations that we do are in the pulling method. It is more beneficial to associations. And I think it gives them more flexibility. If something needs to be done, they don't have to go out and special assess if they don't have it in their component method. So most of mine are on the pulling method.
Excellent. Yeah, and you took the words right out of my mouth, Nicole. Pooling, in my opinion, is more advantageous than the component method. Pooling just gives the board the flexibility where if a particular project is costing more than what you have otherwise set aside reserve fund wise, then you could dip into the pool and kind of borrow from some of the other categories. It gives you that flexibility. Of course, there's some downside. The downside is if you spend so much money on a roof replacement project, there's not much left over for the other reserve categories, then you're going to deplete your reserves just as it relates to one particular project itself. So that's the negative, but you know, you're too constrained typically under the component straight line method. So I typically recommend you utilize the pooling to just buy yourself a little bit of flexibility.
Me too.
And you know, it's worth repeating that HOAs, homeowners associations, 98 to 99% of the time don't have to deal with this. This requirement that reserves be collected in the manner in which Nicole is describing does not apply to homeowners associations unless, as Nicole stated, in the rare case, your governing documents mandate that reserves be collected, and that's almost never the case. And why is that never the case? Who creates the initial declaration? The developer. And when the developer creates these declarations, they want to keep their expenses as low as possible because they're in control of the association for a good number of years. And if they mandate the collection of reserves, then they'll be obligated to fill up the association's coffers with reserves when they own most of the homes in the community while they're in the process of selling them. So you almost never see the developer creating a mandatory collection of reserves for a homeowners association. In the other case, you could have the membership. Take a vote, 51% of the members vote to make it mandatory to collect reserves. Again, that's rare. Why? Because members will be informed that will probably cause an increase in assessments, even though it might be the right thing to do anyway. So in the absence of those two things, namely specific express language in your declaration requiring reserves be collected, or a special membership vote with the homeowner association membership to mandate reserves be collected in a budget, and then an HOA does not have the budget reserves. Is it still a good idea to collect for reserves as an HOA? Of course. Obviously, they have a different set of future expenditures compared to a condominium association. You still have a clubhouse that you may have to deal with and paint and replace a roof and replace roads, etc. But it differs to a great degree compared to a condominium association. And when homeowner associations actually do collect reserves and they actually budget for it, but it's not mandated, are those actual reserves? The answer is no. What it is just a contingency fund. It's not mandatory reserves, even if they slap the label of reserves on that proposed budget. Even if there's a special column that says reserves, year after year after year, money's collected for that purpose, and money's even segregated under this so-called reserve category for the homeowner association. All it is it's a contingency fund to perhaps pay for certain costs and expenses later on. But what happens if the association wants to dip into that for a different purpose, whatever purpose it may be? There's an operating deficit. They can. Those monies are not locked up the way the typical reserve funds in condominium association world are locked up. So just be mindful of that. Now I'm going to tell you to buckle up, because we're going to go into SB4, which is that May 2022 legislation, which frankly could be the subject of its own at least 2-hour seminar, if not an all-day one. And again, I'm going to caveat everything I'm about to say about SB4. Again, this is for my condo association friends. For homeowner association friends, this might be a good time to get a drink, go to the bathroom, make a phone call. But for condo association folks, this still applies until it doesn't. And we hear quite a bit of scuttlebutt or these quote unquote glitch bills out there to fix a few things. Maybe there is a House version, there's a Senate version in Tallahassee that's being circulated. How these bills will be reconciled and what the final bill may or may not be, and ultimately signed by the governor, we don't know. So we have to assume, at least for today, that this is what the law is and will be. I'll try and make reference along the way to a couple of the possible glitch fixes that could be coming down the pike. So SB4, May of 2022, this is when this law came into place. And as Nicole stated, this is obviously a direct result of the collapse of Champlain Towers and Surfside. And most community association practitioners, property managers believe this is, while it was a horrific disaster down there where 90+ people lost their life, legislatively, this is probably the wrong way to address it, and it's having some serious financial repercussions on condominium associations. So I'm just going to bullet point some of the aspects of this law. If a building contains at least 3 habitable stories, so it's 3 stories or more, 2 stories or less, this does not apply to you, with the exception of the reserve issue that I was mentioning before. A milestone inspection is now required to be conducted once the building reaches 30 years of age, and 10 years after that, each 10-year period after that. This 30 years of age determination is measured from the date that the certificate of occupancy is issued by the building department. Buildings that have yet to reach the 30 years of age mark, the initial milestone inspections must be completed no later than December 31st of the same year in which the building reaches 30 years of age. Right? If a building received its CO on or before July 1st, 1992, then the association must conduct its first milestone inspection, that's an important report, before December 31, 2024. That all important date, keep that in your head, December 31, 2024, which may be pushed back, and I'll explain to you what they're considering in a minute. If a building is situated within 3 miles of a coastline, then the association must have a milestone inspection performed no later than December 31 of the year in which the building reaches 25 years of age. So our condo buildings close to the ocean, it becomes 25 years, which age is measured again from the CO, and then 10 years thereafter. So what is a milestone inspection? What does that even mean? A milestone inspection is a very specific type of inspection that must be conducted by either a licensed architect or an engineer authorized to practice in Florida for purposes of attesting to the life, safety, and adequacy of the structural components of a building. So a list of structural components: roof, load-bearing walls or primary structural members, floor, foundation, fireproofing, fire protection systems, plumbing, electrical systems, waterproofing, exterior painting, windows, and here's the big catch-all: any other item that has a deferred maintenance expense or replacement cost that exceeds $10,000. And here's the crazy language that was added: and the failure to replace or maintain such item that negatively affects the items listed above. So this catch-all, everything else that's not listed in this A through J that I just identified, that somehow could impact A through J, also it must be the subject of collection reserves. It's basically expanding the list of components for which reserves must be collected, well beyond what the original statute contemplated, which makes it very difficult to even figure out what you need to collect for, because it's too expansive. Now, one of the potential fixes and glitch fixes rather, that's being debated includes removing foundations as one of those items, which is a big deal because foundations are, and Rudy knows this probably better than I do, and probably could talk about these issues far better than I can. M2E is a terrific firm, by the way. I've used them many times. Foundations are, if the glitch build goes into place, foundations will not be part of that list of components. Also, they're knowing full well that our engineers and licensed architects are going to be and are already grossly overwhelmed with the demand to conduct these milestone inspection reports. They're increasing the potential folks that could conduct these reports for associations to include licensed building officials, licensed building inspectors, certain types of contractors. So we may, again, I emphasize may, because this is not the law yet, might be able to go beyond just having to get that structural engineer or licensed architect in order to get done what needs to get done, prior to December 31, 2024. The milestone inspection will unfold in 2 phases. Phase 1, the inspector, will perform a visual examination of the habitable and non-habitable areas of the building. If there are no signs of substantial structural deterioration, then phase 2 is not required, but it's still an involved report that needs to be generated. And substantial structural deterioration is described as substantial structural distress that negatively affects the building's general structural condition and integrity. It's a mouthful, but those are the guideposts. Phase 2 involves certain tests that are left to the discretion of the inspector, and they'll have to prepare detailed reports as it relates to the proposed fixes for the conditions that are of concern. The reports have to be maintained for 15 years. Of course, any unit owner will have the right to inspect a copy of same, and the associations will be responsible for scheduling any and all costs arising for the inspection. So that's generally the thumbnail summary of that bill, along with the integrity reserve study, which is a big deal as well. That must be conducted by December 31, 2024, which will tell us, you guys, condominium associations, how much you need to collect in order to deal with all these components that have a deteriorating or finite life to them. So, and that reserve study will need to be done by December 31, 2024. Now, let me caveat some of what I just that this December 31, 2024 date may be pushed outward as part of a possible glitch bill, provided the association, they may not have the report yet, but if they have a contract for the report to be performed and done, that will suffice. Again, if the glitch bill goes through. So, these specialists are certainly going to be backed up over the next year and a half. The legislature, I guess, has recognized that on some level. So they're saying, okay, if you don't actually have the report yet, but you have a contract in place for the report to be put into place, to be done, to be formed, to be given to you prior to this December 31, 2024 date, will deem you to be compliant with the statute, which is from your perspective as a board member. So at least you won't be held as breaching your fiduciary obligation, something I've mentioned before. So that's my SB4 glitch bill speech. I was just mentioning one aspect of these reports, that they have to be made available for inspection to the ownership. And that's a whole process in and of itself, which is a dangerous one, an important one for you as board members to understand. Each owner, member of an association, true for HOAs, condos, co-ops, have the right to inspect the business records of the association. The business records are defined by statute in 720, 718, 719, as far as what documents constitute a business record. If an owner makes a proper request to inspect these records, and what is a proper request? Is an email a proper request? The answer is no. Is a demand at a board of directors meeting, I demand to see X, Y, and Z. That is not a proper request. In all statutes, 719, 718, 720, they all say an inspection of the records must be requested, meaning a letter must be mailed to the association demanding to inspect the business records of the association. That then triggers the association to gather up the category of documents, provided they constitute a business record, and make them available for an owner to inspect those records at a location no further than 45 miles from the community association. Now, at that, in lieu of that quote unquote inspection process, the association does have the right, if they so choose, to be accommodating, to simply email the documents to the owner if you want, and that will be deemed compliant. But you don't have to. And my opinion, when you have an owner making repetitive, endless requests, and that's typically these requests are made by a small minority of owners and over and over again, I say make them jump through the hoops, make them show up and inspect the records. And then if they want to get copies, they can at a certain cost and expense to be borne by them. Rules and regulations are also a good idea to adopt as it relates to the business records inspection procedure, which sets forth certain parameters. Namely, you as an owner cannot demand more than 5 categories of documents in a certain request. That avoids having an owner send in a request with 30 different sets of documents that they're demanding within 10 business days. And that's the time period, by the way. Association has to gather up these documents for inspection within 10 business days of the receipt of the request. Failure to do so statutorily entitles the owner to a penalty of $50 per day up to a cap of $500. Well, $500 doesn't seem like the end of the world, but it's never fun to write a check to any owner for any statutory penalty. And if the association doesn't pay the penalty, if it's applicable, and it's only applicable if the association is deemed to willfully have failed to comply with the inspection request. But if that occurred and the statutory fine is not paid to the owner could file suit against the association after exhausting something called a pre-suit statutory mediation process. And I've seen extensive lawsuits over simple things like business inspection records requests involving associations' failure to comply. So we don't want to be in that situation. We want to be mindful of the association's obligation to timely gather these documents, which could be a real arduous, difficult, time-consuming task, which the way to protect the association in those instances is to have strong rules and regulations to make the owner pay for the reasonable costs associated with that process, including administrative fees and hourly fee for the property manager to work on this. And that might be just enough disincentive for an owner to think twice about making that 8th business records request in the span of 6 weeks. So business records requests are something to be aware of. And if it comes to you as a board member, make sure you immediately turn it over to your property manager and/or association counsel. Okay, so Nicole, you're up as it relates to counting procedures for the collection of monies owed the association on a delinquent account.
Okay.
I
So for
just want to
the,
interject, excuse me,
Yep.
that it's 1:30, so.
okay.
Thanks, Peggy.
Thank you, Peggy. Mine won't be that long. It's pretty straightforward on regards to delinquency owners. The first thing is make sure that when you're budgeting, that if you have anybody that is delinquent in the community, make sure you're looking at the receivable report when you're doing your budget. Because you really need to look at anything 90 days and older and say, do we need to add into our budget something called an allowance for bad debt? You always want to have that in your budget. If you don't include that and you have owners that are not paying, you're actually going to be short at year end, cash wise, in paying your bills because you're not going to collect all that revenue. So you really need to build into the budget an allowance for bad debt. Then what happens is you're not writing that off. We tell our boards you're never directly writing anything off until the attorney tells you that you're not going to collect it or you're not pursuing it any further and it needs to be written off. It just stays on the books as an allowance for bad debt. So you record the receivable and then the offset to that is the allowance for bad debt. Now, if the attorney comes back and says, yes, we've collected this amount of money, but it's different than what's owed you, you'll come in and you're going to actually directly write off the receivable and it's going to become a bad debt expense and it's going to be directly written off the receivable. But none of this takes place until it's actually told to us that we're writing it off. So we see back in 2008, 2009, this was really an issue back in the financial statements because so many associations had delinquencies and they had to sit back and say, what do we need to build into our budget as an allowance for bad debt? And then when they started recovering the monies, how were they going to handle this? Do we directly write it off? But I always recommend leave it on the books as an allowance for bad debt. And then when you're told that you're not going to collect it or you do collect it, that you actually record it as a write-off. If you receive more, then it actually becomes income to the association. That rarely happens. It's usually either under what the receivable is, and then there's a write-off that's actually happening on your income statement.
Great, thanks, Nicole. So now I'm going to talk about how we avoid bad debt. And as Nicole will deal with that, if it becomes necessary, but my job is to try to have this issue never get to Nicole because we want to collect 100 cents on the dollar. My philosophy as it relates to collections of assessments is to be aggressive, properly aggressive on behalf of an association. The assessments to the association are the lifeblood of your community, right? You need that to pay your bills. Most importantly, your attorney. I'm just kidding. So what are the 4 stages of the collection process? Used to be 3, but our legislature decided to add something to the process. New step number 1 involves something called a notice of late assessment letter. The legislature came up with the idea of, hey, before the big bad law firms and attorneys start sending out nasty letters to delinquent owners demanding that assessments be paid and with attorney's fees on top of that, we're going to create a process to allow the owner to pay up before it gets to the law firm. I don't think it's a terrible idea, actually. And that's called the notice of late assessment letter. And that is generally sent out by your property management company. And it is a letter that is supposed to identify the categories of amounts that are due and owing, obviously the assessments, if there are any late fees or default interest, and the owner will have 30 days to pay up that balance. And if that balance is paid, then the collection is over and no attorney's fees will be incurred. Let's say the owner has not paid the amounts due and owing the association and 30 days has gone by. That's when the file could be turned over to the association's attorney. And that's when step 2 begins, and it's called a notice of intent to file a lien letter. It's essentially a demand letter from the law firm saying you owe X dollars, the assessments, late fees, interest, plus attorney's fees, to prepare this letter for a total amount of Y. And that goes to the owner. And it's very important that once that letter goes out from the attorney's office, or the file rather, is even turned over to the association, that if the owner calls up the management company or calls up you guys as board members, that the owner be directed to the law firm, because after collection has been initiated on the law firm side of things, the amounts that the property manager may have in their system may not include attorney fees. And same for you as a board member, although you should never be giving out any balances to any owners. It should always be a property manager or an accounting firm, if you have an accounting firm, handling your collections. So just always redirect them to the law firm for that purpose. So the money can be collected by the law firm, and we have an accurate balance, and 100 cents on the owed dollars comes in. So we send out that notice of intent to file a lien letter. And then from there, if 45 days has gone by, and we move to step 3, filing a claim of lien. So same is true in terms of the itemization of the amounts due and owing, the assessments, the late fees, default interest, maybe there are administrative fees if we're allowed to collect that, plus attorney's fees, all itemized in the claim of lien, then recorded in the public records. A lien on the property has taken place as a result of that process. Copy of the claim of lien letter recorded in the public records is sent to the owner to try and get the owner's attention at that point. And if the owner gets that claim of lien letter, and sometimes they do, if they call the property manager or you folks through your accounting firm, again, redirect them to the law firm, because we have the correct balances in hand for purposes of giving out that payoff. 45 days goes by and they still haven't paid after the recording of the claim of lien. That's where we could go to the final stage, which is a big one and an important one, and one that needs some thought and quite a bit of computation in terms of the risk, reward, costs, etc. Filing a lien foreclosure case. Just like a bank could file a mortgage foreclosure, we as an association have the right to foreclose on that claim of lien and take that person's house if they continue to not pay up what is owed. But that's a lawsuit. That's litigation. And that does cost money, far more than the filing of a claim of lien, or certainly the notice of intent to file a lien letter. And that's in the thousands of dollars. So the decision to file that lawsuit, that lien foreclosure action, needs to be based upon several factors. First thing, is there a mortgage foreclosure currently bearing down on the existing owner? Is the bank that holds a mortgage on this property about to foreclose themselves on the unit? If the answer is yes, it really doesn't make sense from the association's perspective to spend money ourselves to try and do the same thing, because the bank is going to have priority in terms of taking the house away. So the first order of business on our side is to check to see if there is a mortgage foreclosure pending. If no, we always check to see if there's a mortgage. And while we can't tell necessarily as to whether or not there is a delinquency on the mortgage, it's still good to know that if there's a mortgage on the property and we as the association end up with title to this property, which could be the end result of the lien foreclosure, that there'll be a mortgage encumbering the property. Now, question I'm oftentimes asked is, well, okay, if we take title to the property as a consequence of our lien foreclosure, do we then have to make the mortgage payments to the bank? The answer is no. The association does not have an obligation to pay the bank. So that's a factor, though, because the association can't then just go resell the property. You have a property encumbered with a mortgage that almost certainly will exceed the value, making it impossible to sell. Then you may say, but Scott, why the heck would we want to foreclose? The answer is, if the property is in decent enough condition and it's a rentable piece of property, associations all the time, including my clients, will own the property through the lien foreclosure and will rent it out to a third party, perhaps for years and years and years and years. And that will result in a fair amount of rental income coming into the association, which I'm going to ask Nicole after this. How do we treat that from a tax perspective, that rental income? But that could fill up the coffers of the association and pay down, if not eliminate, the delinquency on this account. I saw a question come in: are these time periods cumulative, or are they stacked up one against the other? And it's the latter. So It's first, the notice of late assessment is 30 days, and then we have to, and once that time period goes by, we could send the notice of intent to file a lien. Then we have to wait 45 days on top of that, and then the claim of lien can get recorded. We have to wait 45 days on top of that in order to file the lien foreclosure action. That was a question I just saw. So before diving into the lien foreclosure, which oftentimes is very effective, because while you'll have owners that may ignore a letter or 2 letters, and may even ignore the filing of a claim of lien, when you got a process server knocking at your door and serving upon you as an owner a lawsuit for foreclosure of your home, it tends to get your attention. And what usually results is the owner contacts our office, asks for the total balance, always inclusive of all the attorney's fees and filing costs, obviously the outstanding assessments, late fees, default interest. We get that check, case is dismissed, account is current. Sometimes there may be payment plans that are asked or requested, and depending upon the reasonableness of the payment plan, it'll be up to you folks as a board to make that decision to accept the payment plan or not. Maybe come up with a counter offer, something a bit tighter, maybe more money down as a lump sum payment. You have that flexibility. It's purely a negotiation. Let me talk about quickly. I know we're fast running out of time. Like I said in the beginning, there's so much to cover and so little time. But mortgage foreclosures. What happens when a bank? Well, before I get into that, I got to conclude and crystallize the end process for the lien foreclosure. Because while I said, I don't know, a minute or so ago, that you folks as the association could end up owning this property, that is true. What also is true is that a third party could step in and bid at our lien foreclosure sale and bid above what we are owed, because we as an association are entitled to something called an automatic bid at our lien foreclosure sale that's handled by the clerk of court. Hypothetical. The association is owed $15,000 in assessments, attorney's fees, interest, default, etc. That is our automatic bid, where we don't have to come up with that money at the foreclosure sale. So we're locked in at that amount. If someone says, you know what, I got the bright idea of buying this property for $20,000, and I see there's a mortgage, but I'm going to rent it out for $3,500 a month, and I think I could, I could get a good return on my money. And that third party comes in and bids above our $15,000. They bid that $20,000 number. It goes into the clerk of court's registry. Well, they are the successful high bidder. And what occurs logistically from there? 15,000 of that 20 comes back to us to pay off our balance, and we're even. The account is current. That third party bidder, they become the new owner of the property. And they will then pick up upon the issuance of the new title by the clerk of court, something called the certificate of title. They will owe the assessments from that point forward, from the issuance of their certificate of title. So not a bad result. We've gotten our balance paid in full, and we got a new person or company or party on the hook to pay the assessments going forward. Sometimes there's a surplus. Like I said, in that scenario, what happens with that extra $5,000 when someone bids 20 and we're only owed 15? Well, we do this routinely. Sometimes there are amounts that accrue in the account post the final judgment being entered. Assessments that continue to accrue, or there's some fines that have taken place, or we have to spend money cleaning up the property, and we throw that on the ledger. We, the association, go after that surplus to recoup those funds. So there's an ability when there's a surplus like that to collect those monies. Surpluses also come up in the context of mortgage foreclosures and tax deed sales. So when a bank forecloses on property and that third party guy decides to go in and bid on that property beyond what the bank is owed, and there's surplus money because there's a higher bid than what's actually owed to the bank, and that surplus sits into the court's registry, we as the association will know about it because we're on top of it. We make a claim for those surplus funds on behalf of the association when there's a delinquency of any amount on the account. And same is true for a property tax deed sale, where property is sometimes lost through the non-payment of property taxes. And we monitor those. And if the account is delinquent on some level, we'll make a claim for those property tax sale deed surplus monies as well. Going back to the mortgage foreclosure, if the bank is the high bidder and there's no third party bidding above them, what occurs in terms of the account balance. The bank is obligated to pay something called the safe harbor amount, which is a statutory sum that says the bank has to pay 1% of the principal balance of the existing mortgage or 1 year's worth of assessments owed the association, whichever is less. Hypothetical. There's a $300,000 mortgage on the property, and that was foreclosed on by the bank. 1% being $3,000. 1 year's worth of assessments, total $2,000 in total for 1 year's worth of assessments. The lesser of those two sums, in this case, $2,000, that's what the bank would automatically immediately owe the association, the $2,000 sum. Do the banks just say, okay, here's my safe harbor payment? They never do. We always have to demand it of them. And you see when the certificate of title is issued, when the certificate of title is issued in favor of the bank, then bank will then be on the hook for all assessments continuing and going forward. Okay, last point is in terms of collections, because I know we're running out of time. Then I'm going to throw it back to Nicole on rental income. Board members, be careful not to involve yourself in the collection process. Never, never, ever, never, never, ever post or send an email or put something on Facebook, a list of delinquencies and delinquent owners, because you want to shame them or encourage them to get their name off of this list. That is almost certainly a Federal Fair Debt Collection Practices Act violation, because it's a level of harassment and a violation of federal law, and you could easily get sued as a board member individually for doing so. Don't get involved. Have your property manager handle it. They know, where it needs to go and the timeframes, and eventually, the attorney will handle it. If there's an accounting firm, they need to interface with the law firm that's handling collections. But shy away from knocking at someone's door and saying, hey, Mr. and Mrs. Smith, you owe $1,000 to the association. You know how short of funds we are over here. You need to pay. Don't do it. It's, even though you think it's the right thing to do, you will get in trouble potentially. So shy away from even thinking it. Okay, so Nicole, so when rental income comes in, as far as like that situation where the association forecloses on the property, is renting it out, we're a not-for-profit corporation, but is it rental income from a tax perspective?
So you guys are a not-for-profit in the state of Florida, but with Internal Revenue Service, you are a profit organization. It depends on every association, they're different. Some file the 1120 with the Florida 1120 because they don't qualify to file the 1120H. But regardless if you're following the 1120H homeowners association tax return or the 1120 regular corporation tax return, all rental income would be subject to tax. The 1120H is the 30% tax rate. What we try to do is, and every firm does, is try to offset that rental income with expenses, indirect and direct expenses. But any monies that are collected from outside of the membership are always subject to tax. So you would have a potential liability on those rental incomes. The same thing when you were talking about the mortgage foreclosure. And if you sell a unit, let's say you take a unit, you purchase it, and then you sell it, and you sell it for more than your basis. What I mean by your basis is your basis in the unit would be when you take the unit over and that receivable is on the books, that is your basis in that unit. And then anything that you do to the unit. So let's say you do repairs or you add things to the unit, that adds to your basis. But associations usually have very low basis. So when they sell a unit, that's considered a gain. So if they sell it for more than what that basis is, they are subject to tax on that also. There is a potential tax liability. On the 1120H, it would be 30%. And on the 1120, it's a scaling tax rate on that. But you would be subject to tax. That is not exempt function income under associations.
Great. And let me add to another tool in our toolbox in terms of collections. When you have a delinquent account and the property happens to be rented, that's rare, but it does occur. We have an investor owner, they're renting out the unit, but silly for them, they're not paying the assessments. Well, what we have the ability to do, condos and HOAs, is send a tenant rent demand letter, meaning the association could demand the tenant turn over their rental payments to the association. And tenants oftentimes say, well, wait a second, if I don't pay the rent to my landlord, they're going to evict me. It's not true. They are statutorily protected from getting evicted by their landlord if the association demands rental payments be remitted to the association due to an existing delinquency. And in that situation, we're simply taking those rental payments and paying down the existing balance on the account. So that, Nicole, correct me if I'm wrong, that would not be a taxable event, right? Because it's off,
No.
it's offsetting an existing delinquency.
Correct.
So, okay, I know we have about 5 or 6 minutes left, and I got to get to, I know we have a ton of questions. So I wish I could get to all of them, but I got to cover covenant enforcement and fining, our favorite topic for board members. We love to fine people.
Yeah.
So let's talk about fining. So let's start with the easy thing. When can you fine and when can you not fine? Well, starts with the basic proposition that you have to have a fine committee. If you do not have a properly constituted fine committee, no matter how terrible the behavior is or how egregious the violation is on the part of that owner, if we don't have a fine committee, even if we tried super hard to get fine committee members, we can't fine. And I deliver that unfortunate, difficult news all the time. And I encourage my association clients, somehow, some way, find 3 brave souls to sit on the fine committee. And that's what you need, at least 3 persons who are brave. And those persons cannot be board members, can't be you guys, and it can't be related to you. So independent owners, and they must be members. They can't be outside persons who don't have any interest in the property in your community. But let's say you're able to get that fine committee together, and those fine committee members should be specifically appointed by you guys at a board of directors meeting, reflected in meeting minutes, because sometimes owners aren't so happy about getting fined and they get attorneys trying to check in as to the process, whether or not this is a properly constituted fine committee or not. So you want to have evidence, written meeting minutes to show that your fine committee was properly established and the person's appointed. On your other abilities to enforce a covenant, a violation letter, certainly, and whether it's from the property management company or from the attorney, usually the property management company will start with kind of some reminder letters, and which is proper, but give them some deadlines, to take certain action. And at times it will be turned over to me to write a bit more of a forceful violation letter to get the owner's attention. And sometimes it works and sometimes it doesn't. So let's say it hasn't yet worked in spite of the brilliance of the letter that I've sent to them and the management company's letter. Our options include possibly filing a lawsuit. But before we get there, there's a mandated, and this is true for condominium associations as well as HOAs, as well as co-ops, a pre-suit statutory mediation process. So if you have someone in violation of our covenants and restrictions, before jumping in to file a lawsuit to try and get an injunction to force them to do something, we have to avail ourselves from the pre-suit statutory mediation by sending a very specific letter demanding that they participate in this mediation. If they refuse to do so, fail to respond, then we can file that lawsuit for injunctive relief, it's called, seeking a court order, asking a judge to have an owner do something or not do something. One example that comes up, and I filed several lawsuits involving situations like this, where improper rental activity, where if you have rental procedures that are just being ignored by a certain owner, and they're throwing Airbnb, VRBO folks into the property, and the property is kind of acting like a mini hotel in flagrant violation of our rules and regulations or our covenants and restrictions, we can file a lawsuit to compel them to stop doing so. And if they continue to do so, even in the face of a court order, they could be held in contempt. And part of that lawsuit, it's a violation of the declaration, and it would include the reimbursement of all attorneys' fees and costs. So it's a powerful tool, but we still have to abide by this pre-suit statutory mediation process first. You could also, as part of the violation process, and including through the fine committee, suspend use privileges, suspend their ability to use the pool or the clubhouse or the tennis courts. So that could be part of the process of fining. Now, let me just make sure we all understand how it works with the fine committee. The fine committee does not go first. The board goes first. If there's a violation to which a fine is sought to be imposed by the board has to impose that fine at a board of directors meeting. And it should be reflected in meeting minutes, including if we're going to suspend any use privileges. From then after that, the fine committee, assuming it's in existence, there will be a notice sent out to the owner indicating that there's a fine committee set up that's going to hear your matter. That notice must have gone out at least 14 days in advance. This is the violation. This is the fine that the fine committee is considering to impose. This is the suspension of use privileges that they're considering to uphold. And then the fine committee either accepts or rejects the determination of the board. The fine committee is not supposed to do something other than accept or reject. They're not supposed to say, you know, we'll just cut the fine in half, or we'll give them more time to fix their situation. That's not within their purview statutorily. They can only accept or reject. So it's important you go through that process. Board acts first, reflected in the meeting minutes, then a fine committee hearing is established. The notice goes out to the owner at least 14 days in advance of that fine committee hearing. And then there'll be a kind of like a mini quasi trial at the fine committee hearing, where the association's representative will state their case as to why a violation exists. The owner will have the right to be present and present their side. Then the 3-member fine committee will make a decision. And then the fine can be chargeable within 5 days thereafter. There's a whole bunch of other stuff I didn't get to, but I figured that was going to be the case. I think we're at our 2 p.m. cutoff. So I just want to thank everyone for listening. Hopefully it was useful. I believe you should have mine, Nicole's information. Send us emails and we'll be happy to try and answer your questions if we didn't get to it today. Major thanks to Peggy and to Vinteum for setting this up, and we can't do this without them. For Rudy for moderating, and for all of our sponsors, again, we suggest you patronage them. So thanks again for listening, and hope to see you next time.
Sounds good. I just want to close with some announcements. The upcoming webinars on April 5th, we have M2E Engineering supporting a Tampa-centric webinar with George Root, an attorney, and also Robert Mitchell of Mitchell Insurance, discussing insurance and all the situations going on. April the 12th, we have a Spanish presentation, board presentation in Spanish for board certification. April 19th, we have the hurricane readiness and a panel. And April 25th, we have another M2E Engineering Orlando-centric webinar. So look for the flyers and the dates. Thanks so much, everyone, again. Great presentation, Scott and Nicole. Bye-bye.
Thanks,
everyone.
everybody. Great job.
Thank you, everybody.
Thanks, everyone. Bye.